if you have a good insurance agent and you're getting multiple quotes and they're showing you different options, you should be able to very clearly see what the differences are between the different types of policies that are being shown to you. And this is usually why we recommend going to an independent insurance agent that is not affiliated with a specific quote-unquote insurance company, big box insurance company. Like if you go to a State Farm agent, you're going to get State Farm quotes. If you go to a Nationwide, right? So if you go to an independent insurance agent, typically they'll give you quotes from a number of different insurance companies and can better tailor your coverage.
The coverage on the auto gets so high that what's required that you really don't need that $1 more million worth of coverage on your policy. So you don't necessarily need to get the $2 million policy. The one was enough because of what the auto covered on top of it. So kind of work through that. Talk to your financial planner. They will walk you through exactly how much coverage you should have.
Good morning, good afternoon, good evening, whatever time you're listening to this. This is the Retirement Planning Happy Hour with Eric Douglas, Chris Vaughn, Family Wealth Planning Partners based out of Louisville, Kentucky. Thank you for joining us for another episode here. Riveting stuff today. Everyone's favorite topic, as always, is insurance, right? And so we had some insurance things that we were going to run through. I know Chris had some recent examples, as do I. Yep. So we have a few talking points around insurance, and who knows what fun places that'll take us to, right? So we'll
Can there be a more exciting subject of insurance?
Taxes is probably the only thing I can think of that might be more exciting than insurance, right? But all that to say, we also have an interesting bourbon today, one that I've never even seen or heard of. A little bit different, so I will let you introduce the bourbon, and we'll hop into our topic.
Okay, so what we're drinking today is Buffalo Trace Kosher Wheat Recipe. So I thought this one would be a timely one. It is roughly, I guess we're into the second half of April now as we're recording this, and this has to be done. They do this every year. It's a limited release every year that is done after Passover, which was beginning of this month. Now, I'm not Jewish. You're not Jewish. So you say, well, what does kosher mean? I'm probably going to say this wrong, but it basically means that things have to be clean to a very, very high level. I'm not a big hot dog eater. You know, when I go to a football game or something like that, or a baseball game, I might get a hot dog. If I buy hot dogs for a summer grill, it would be like once every 3 or 4 years. You know, but I know we always get the Hebrew national ones because they're the best hot dogs. Yeah. And I think it has something to do with that. So anyway, this is the exact same recipe as Weller, which we've done several Wellers here recently, along with the Green River Wheated that we all raved about. That was so good. So this is another wheater. It's the same exact mash bill that Buffalo Trace uses for all their wheated bourbons. So all the Wellers, the Pappies, all that, the same juice, but it's done a little bit differently. And so that I don't screw this up, I'm going to read part of this off the back. This is produced in partnership with the Chicago Rabbinical Council, or the CRC. It's made with the same quality grains as the WL Weller, blah, blah, blah. The kosher spirit was aged in specifically designated kosher barrels, although not kosher for Passover in order to avoid issues of Jewish ownership over Passover. These barrels were sold to a non-Jewish executive in a ceremony witnessed by a representative from the CRC. After aging 7 years, so there's a number that's important. This is 7-year-old bourbon. It's bottled at 94 proof. And here's an interesting one, and this is after ensuring that the bottling lines were cleaned beforehand and that no contact was made with non-kosher spirits. And then it goes on to leave some, it's after Passover every year when they release it. And it's got some tasting notes that I'm not going to look into because you don't want to kind of get that in your head and then you tend to taste that. So this is different. There is also a rye recipe of this, which I did not bring because I know you're not a rye guy. I don't think that they do this with Mash Bill 1 or Mash Bill 2, but if I'm wrong, somebody put that in the comments and we'll have to go find that. I've had this multiple times. I have shared this with people multiple times. I've never had anybody say something negative. So I thought, since the time of the year, we're at the release time of the year, Yeah, there's a little dust on the bottle because this one's a few years old. I thought it would be fun to bring this one in and just kind of get something different. So that's the bourbon that we're drinking today.
Yeah. So like I said, I've never even heard of this.
Yeah.
This line. So definitely interesting. New to me, for sure.
Yeah.
So never had a
I will
bottle
tell
of bourbon
you,
with talking about the Chicago
really,
Rabbinical
really
Council.
difficult to find because when they do put it out, and I don't know if they release this outside of the Kentucky market. Some things they don't. When they do release it, the people who have had it before, like me, are going to snatch it up very, very quickly. This is not expensive. If I remember correctly, this sells for like $45 or $50. It's not expensive if you can get it at retail, but you got to get it when it comes out. So hopefully for those of you who are going, I'm going to rush right out and wait in line to get that.
I've never even seen it in a store before.
Yeah, it's usually held on the back shelf for the higher value spenders, but it's the big box stores where you're likely to find it at a retail price. So anyway,
well,
let's talk about the second most exciting subject in the world behind tax, and that's insurance planning.
Well, this was your idea to talk about insurance today because I wanted no part of talking about insurance because
I've been browbeating him for a while, but we've both had some things happen in the last week. It's like, this is an insurance topic
and it took me going through the show notes from over the past year to realize we haven't really talked about insurance too terribly much lately at all. So, but you had an instance and some stuff going on in your world, at least with some of your folks that you're working with. So why don't you kind of take the lead and.
Okay, so there's a lot of different types of insurance. So let's see, just kind of hit some of the high points, the different areas. So there's life insurance, which can be divided into a couple of different categories. There's disability insurance. And then there's, of course, supplemental health insurance and things like that. There's major medical health insurance. There's the one where I think we're going to spend most of our time today is what's called property and casualty. So just to what most people call that's your homeowners, your renters insurance, your auto policies, umbrella policies, things of that nature. That's the typical types of insurance that you're looking at under property and casualty. And I have had an incident in my life this week that insurance is going to come into play. So let's just start with the property and casualty part. So auto, homeowners, and then the umbrella policy, and obviously renters if you don't have a homeowner's policy. So what happened to me this week, as you are aware?
As I'm aware, yes.
This is just one of those bad luck things. My personal car, and we've talked about, being car junkies or not being car junkies, and you drive a 10-year-old Toyota Camry and you're perfectly happy with that. I've got a 9-year-old Mercedes that I baby. I love it. Had to go into the shop. Friday last week, took it in. Turns out there's a problem. Ouch. It's one of those things that happens. Car was in the shop all week. My family with 4 people working jobs and going to school, dealing with 2 cars. We've had some logistical problems. Yesterday, went in to pick my car up. My son took me. He's driving my wife's car. He took me, dropped me off, and then he had to go into downtown Louisville because he was working on a research project for one of his courses. Drops me off. I'm driving my car. I'm happy. I get a phone call. CJ has had a wreck in downtown Louisville. Now, remember, we're Shelby County people, so going downtown is a little overwhelming if you're not used to it. You know what? He's fine. Okay, full disclosure, he's fine. But the conversation that he had with the individual that hit him, he did get T-boned. That conversation, along with a quote-unquote witness, I'm going to get into witnesses later, was basically that he had done something that he's not allowed to do. He turned left from a one-way onto a one-way. He turned left from a lane that you are only allowed to go straight, and that's why the accident happened, right?
Your son turned left.
That's what he was told. Yeah, I got pictures. Nope, he was in a left-hand turn lane. Yeah. Right, and we videoed it, right? So anyway, that's the incident that happened. Once again, he is okay. He had a little burn on his left arm from the airbags, little aloe vera, and you're fine. But that got me thinking, how many times have you talked to a client or a prospective client or a friend or family member, and they said, and I had this conversation this morning when I picked up the rental car. I was told I have full coverage on my cars, right? How many times have we all heard that? So the first thing that we want to make sure that everybody knows is full coverage does not exist. It's not a thing.
Yep.
There's minimum coverage, the state minimum. That's where you see the ads on TV for
low cost,
low cost insurance carriers, and it's like
avoid those at all costs. By the way, yeah.
I did learn something that was very interesting this morning about uninsured, underinsured motorists that I want to come back up to. But anyway, full coverage doesn't exist. There is a minimum, so you have to understand how to read auto policies. The most important part of the policy is that there are 3 numbers, right? And they will usually say them in thousands, and they'll say them back to back to back. So you will hear something like 100, 250, 100, right? Okay, here's what they're referring to, and you've got one that you pulled up that we're going to have a look at. Yep. So here's what 100, 250, 100 means. So those are in thousands of dollars. So 100,000, 250,000, so on. The first number is the coverage. I believe it's comprehensive. I always say these backwards. That's the coverage for medical need per person that your insurance will cover if you are at fault. Okay. The second number is the total amount per incident that the insurance company will pay for if it's your fault. And then the third number is the collision. So this is the property damage that's caused to your vehicle, to somebody else's vehicle, to a building on the side of the road. If you hit that, we had one right over by our old office not too long before we moved, where somebody literally ran off the road and through the wall of a building. Do you remember seeing that over there?
Oh, I remember seeing that. There's also an incident at Twig and Leaf on Bardstown Road.
Oh, yes, I did hear about that.
Someone ran right into Twig and Leaf, and that was an old Bellarmine institution from my days over there. Yeah.
So, okay, that's the collision part. So when people say they have full coverage, where that phrase comes from is, well, if I'm going to take out a loan in order to buy a car, the lender, typically a bank, is going to require that you have full coverage. That's where that misnomer comes in. What they're typically going to require is 100, 250, 100. That's why I said that, but every lender has some different rules, okay? The state minimums here in Kentucky, if I remember correctly, are 25, 50, 25. And that's why I hate those state minimums, because in today's world, repairing a vehicle is unbelievably expensive, because all those little sensors and everything that you've got in the car that are so great, right? The airbag sensors, the airbags themselves, the sensor that says, oh, your oil pressure is a little bit low, the sensor that says there's somebody in your blind spot on the left side. All those little sensors cost a lot of money.
They're tech gadgets.
It's not like repairing a car was 50 years ago.
You're driving a computer now.
You're very much so. And the computer has a boatload of accessories on it that talk to it. And that's why it gets so expensive. The repair that I had to do on my car was actually something pretty simple, right? It was what they call an actuator, which basically means it's a motor, right? Just a little motor.
I'll take your word for it.
It was $1,600. When I got the bill, I definitely had one of those sinking moments. It's like, oh my gosh. But that's because that's the cost of all these little things now. That's the reason our auto insurance is going up so much, at least part of the reason, is because vehicles are so expensive to repair now because they're so much more complex.
Yep.
Right? Once upon a time, if you had a little fender bender, $500, maybe $1,000, and everything's repaired. Oh my gosh, that doesn't pay for the paint that they have to use to repair now, right? Yeah. I can't imagine what this particular one of my wife's cars is going to cost.
Well, right? It's funny you say that, because the last time I bought a car, which it's been quite a few years ago now, but several years ago now, but they always try to sell you the extended warranty, and of course I don't get those, but the thing that the selling point that they were using to try to get me to buy the extended warranty wasn't so much about the car itself breaking down. It was more about the electronics within the car, the tech components within the car. Because if those break down, that's what's more expensive to replace.
That's exactly right.
It was the flat screen, the navigation, all the other,
all that cool stuff that we all like.
Oh yeah.
It costs money.
But that was the way they were basically trying to sell the warranty to you was, well, this stuff can break down. I mean, there's no 100,000 mile warranty on on the tech stuff, right? So,
and that's a perfect example of why, state minimum coverage, when we talk about the collision part, is, if I remember correctly, $25,000. $25,000
ain't going to go very far.
Wow. Yeah. And that's the reason we talk about, they talk about totaling a car very frequently, because the cost of repairing it, because of all those little components, it's worth more than the car, you know? So that's the first part of that. And then the other part, the reason that state minimum is so dangerous, this is actually the worst component, is that $25,000 per person in coverage for medical coverage. $25,000 barely gets you an ambulance ride nowadays.
Yeah.
You know, it is so unbelievably expensive when you figure in all the different costs.
Well, especially when you're adding in the fact that an insurance company is paying for the ambulance.
So
because an insurance company drives the cost up immediately.
Oh, yeah. So, you know, even a fairly minor injury can easily go over $25,000. Yeah. So my son's minor injury was he had a mild burn on his left arm because of the curtain airbags going off. Actually, it wasn't the curtain, it was the side airbag, he said, did it. We solved that with a little bit of aloe vera when he got home last night, because it's basically a sunburn. But some of the injuries that happen they can be truly catastrophic. And that's the reason why the coverage on the medical side needs to be a lot more robust.
Oh, there was I passed a nasty wreck coming to work today over at Shelbyville and Hurstbourne.
Okay.
And right at the corner, they had, traffic was backed up on Hurstbourne, and yeah, they had a fire truck out, and they had jaws of life, and it was nasty. Yikes. So yeah, $25,000 probably wasn't going to cover whatever happened in that wreck. Is not going to cover it.
It wasn't going to cover the cost of one of those fire trucks showing up, right? No. God forbid there's a really serious thing where you end up with like a stat flight or something like that. Mm-hmm. I geek out. One of our partners actually introduced me to this, and I'm mad at him for doing it. There's a neat little app that tracks aircraft. Okay, I'm a nerd. I do this all the time. And out where we live, we are not in the flight patterns, right? So when I do hear aircraft, we actually hear helicopters a lot. So I'll pull out my little app and I'll see what it is. And it's surprising the number of times that it's a stat flight going in between Louisville and either Frankfurt or Lexington, because we are right in that flight path.
Yeah.
You know what? Somebody has got a big bill every time I see that. And I see it couple of times a week, to be real honest. It's more often than you might think. Yeah. So that's where we get in trouble. Now, on the full coverage side, so the 100, 250, 100, or whatever most of them call full coverage, let's apply the same concept. Do you honestly think that $100,000 is going to pay for all the medical bills if there is a fairly serious incident? God forbid that jaws of life story you were talking about. Mm-hmm. In my opinion, you're not even going to approach getting that paid for with that. So what happens if there's an event and it's your fault, okay, and your coverage is not enough to pay the medical bills of the person that was injured, right, or the property that was injured? Well, that money's got to come from somewhere. And therein lies the problem. This is one reason why this is part of financial planning, is to go through this type of insurance planning. You can save hundreds of thousands or millions of dollars over your lifetime. You can be unbelievably disciplined and sacrifice things that you want to do because you know it's going to be more valuable in the future. And then as it turns out, you don't have enough auto coverage and you have an accident and somebody gets hurt. Guess where the money's coming from? All that money that you've saved, or God forbid, even more, right? That's where it's coming from. And that's why it's so important that you have the correct coverage on your auto.
And understanding the difference in this case, as you alluded to it before, understanding the difference between uninsured and underinsured.
And that's the second part of it. That's right. Yeah. So this was another factoid that I got this morning from I'm going to call it a reputable source. I wouldn't stake my reputation on it, but it was reputable. I've known for many years. So uninsured, underinsured, meaning, okay, so I have an accident, and as it turns out, the other guy is not insured, let's just say at all. And I've heard people say, well, I'd sue him. Dude, if he doesn't have insurance, it's because he doesn't have any money, right? You can sue them all you want, but you're not going to get anything except an attorney bill.
Have fun. Good
right?
luck. Yep.
So this is where you got to make sure that you have uninsured, underinsured motorist coverage on your policy. And if your insurance agent is trying to get you the cheapest possible rate in order to keep you as a client, I can assure you this is one of the things that they can drop off in order to reduce your coverage. And as prices are going up, you're going, I don't really need that. Well, okay. Here's the stat that I've known for years, and here's the follow-up stat to it. If you are living here in Kentucky, Kentucky is the 4th highest rate in the country for uninsured, underinsured motorists, right? And Jefferson County, right here in Louisville, is the #1 county in that state.
I've heard that before, yeah.
This is the stat that I heard this morning, or one of them. 1 in 7 drivers in Kentucky does not have enough or any car insurance. So if you have a car accident, that means there's a 1 in 7 shot, or arguably if you have the coverage, it's a 1 in 6 shot, right? If you know your stats, that other person is not insured or does not have enough coverage. Okay, who pays for it? You. And that's the problem why you've got to have this. Now, the other part of that stat I heard, it was really interesting. What's the most popular place to go on vacation for people from this part of the country?
I would imagine Florida.
Florida, absolutely, right? And because Florida is driving distance, if you're willing to, do a little hauling, a lot of people go to Florida on vacation and they drive. They pile everybody in the minivan and they drive down. They spend a week at an Airbnb or at a hotel or whatever the case might be. Guess what the #1 state in the country is for uninsured, underinsured motorists? It's Florida.
For right now, especially, with interest.
It's #1. And the stat that I heard was it is 1 in 4 drivers in Florida is not covered. Right? That should be utterly terrifying because you're sitting at an intersection waiting at a light. Yeah. There's a lot more than 4 people at that intersection, most likely. So that's the danger of not having the proper coverage, because all the saving and all the sacrifice could go away in an instant because of something that wasn't even your fault, right? It was somebody else's fault.
And I didn't really totally – the first time I heard that stat, I wasn't sure how much I believed it or appreciated it. I had a story. This happened to me, I guess, 2 years ago, 2-3 years, something like that. I was at a stoplight, and I was behind another car. Another car was about to turn right into, we were both in the turning lane. The car in front of me was about to take a right-hand turn, and they start pulling out like they were going to turn out.
Right.
So as they start, I'm kind of creeping right behind them, and then I look left to see if it was okay for me to go. As I was looking left, the car in front of me stopped. Don't know why, whatever. But I ran into the back of them. And I'm using the term ran into the back of them very, very loosely. It was, we were creeping at a stoplight, right?
I've seen that exact accident multiple times.
We were creeping at a stoplight. Totally my fault.
Yeah.
Absolutely my fault. I looked left. I should have not taken my eyes off of the person in front of me. I screwed up. It was a tiny little fender bender, whatever. I put my car in park. Step out, as one does whenever you get into a wreck, right? Hey, just to go make sure the other people are okay and check out the car and all that stuff. I hadn't even put a foot on the ground. I think I had my door open. I don't think I had a foot on the ground before that car sped off.
Well, we know why they sped off.
Clearly, they definitely didn't have insurance. But the fact of the matter is they were probably, not documented citizens.
They might not have had a driver's license. They might have been, illegal alien of some. Who knows?
It could have been anything. But at a very minimum, they certainly didn't have insurance, and they did not want a cop coming around to check the fact that they did not have insurance, and they did not want to mess with me.
Right.
They were happy to have a few dents in the back that they had to cover, as opposed to possibly dealing with me, and not even really dealing with me, but possibly dealing with the cops showing up. And
that's a great example of, once again, proper coverage. I remember many, many years ago. This is long before my wife and I met, and we've been married for 30 years. So I was driving over to pick up my girlfriend after she got off work, and she had decided that she was going to go ahead and drive home. And we didn't have cell phones. We didn't communicate well. And I saw the accident. And it was the exact same scenario. It was turning right on a red, right? Car in front of her went. So she looked left and started to go. Or I'm sorry, I said that backwards. She started to go, looked left, and realized there was somebody coming. So She stopped. The car behind her did exactly what you were talking about, right? It turned out it was one of her employees of all things, right?
Yeah.
And rear-ended her, and it was a true fender bender kind of rear end, right? But she had an old school VW Bug. You remember those things?
Oh, yeah.
Right? The engine's in the back. That little bitty fender bender, I mean, we're talking a 2 mile an hour impact, cracked the block on the engine, totaled the car.
Wow.
Right? And that's my point of the story is it totaled the car from a really minor injury. Okay. It's not her fault. She is not obligated to go once she starts moving. If she sees something, you have an obligation to hit the brakes if you think it's unsafe, right? Person behind her was at fault. What if the person behind her doesn't have insurance?
Mm-hmm.
You know, that's kind of the issue of having that kind of coverage. So let's kind of transition that. Unless you actually had a story about that you wanted to share, didn't you?
Well, not necessarily a story, but kind of wanted to run through some examples.
Yeah, there you go.
Yeah, because and actually probably more of the differences are going to be on the homeowner side as well, and we haven't really touched on that.
Right, we'll get to that one, sure.
But this is from a client, and we recently had them update their numbers with an insurance agent and get some recommendations.
Mm-hmm.
Buying a house, right? And so it was a good time to review their coverage.
Right.
Of course, they have to review their coverage on the homeowner side, but usually when you're reviewing your coverage on the homeowner side, most of these things come in package deals.
Yep.
Right? And so it was interesting because they lost their rate lock that they had on their auto insurance. And so their auto insurance was actually set to skyrocket because they were moving into a new home because they had to change their insurance coverage. So they got quoted out. And some of the numbers that you were talking about, I just happen to have their quotes in front of me because we were, kind of reviewing them collectively. But, on the auto liability side, you were talking about that 100, 250, 100 coverage.
Mm-hmm.
The baseline level of insurance that their insurance agent was looking at, because they were making sure, and this is something we discussed, was they wanted to make sure that they were properly covered.
Sure.
If anything were to happen to them, like what you just explained, right? So their base level of coverage on every single one of these quotes was 250, 500, 100.
Okay.
Yeah, so solid coverage on the auto side,
coverage.
Right? They also have uninsured and underinsured motorist coverage.
Excellent. This is a good policy.
What was interesting, one of the quotes had uninsured 250, 500, but underinsured 2550. The other two quotes both had 250, 500 on both the under and uninsured categories. So there was far greater coverage on the underinsured side on two of these quotes, much more so than one of them.
Interesting.
And what's interesting is the one that did not have as much coverage on the underinsured motorist category actually was the most expensive policy.
Oh my gosh.
Now, from what I was told and from what I understand was the insurance agent had said that I guess this specific carrier, when rates had gone up over the last couple of years, they kind of overshot their rate increase, and they've lost a lot of business from that. So they're expecting that those rates will be coming down probably in the near future because of the amount of business that they've lost. But that's neither here nor there, right? But all the other coverage is pretty solid across all of the different quotes. But those were the main things I wanted to highlight was if you have a good insurance agent and you're getting multiple quotes and they're showing you different options, you should be able to very clearly see what the differences are between the different types of policies that are being shown to you. And this is usually why we recommend going to an independent insurance agent that is not affiliated with a specific quote-unquote insurance company, big box insurance company. Like if you go to a State Farm agent, you're going to get State Farm quotes. If you go to a Nationwide, right? Right. So if you go to an independent insurance agent, typically they'll give you quotes from a number of different insurance companies and can better tailor your coverage to your needs.
Right. Now, let's talk about one of the pitfalls of doing that, because we are in agreement that shopping for your P&C insurance through an independent agent is by far the way to go. No offense to the ones out there who work for what we call a captive agency. So the State Farm, as you mentioned, Kentucky Farm Bureau is a huge one here in this area.
Actually, Farm Bureau is great, by the way.
They're great coverage. Don't get me wrong. That's a good company, but they are a captive, right? And I've got a couple of people that are friends that are actually agents for them, so they know they can't shop that around. You got to use their stuff. Okay, so the benefit to the independent is they can shop around through multiple companies. Here's the detriment to it. if you go to an independent insurance agent and you say, and this is why we went on that long diatribe about full coverage, I want full coverage. Go get me the best price I can. Mm-hmm. Guess what they're going to do? They're going to get you the quote unquote full coverage, and they're going to get it as cheap as they can, but they're not going to add on those other things that you might need to protect your financial plan. And from our perspective, that's what we need to do, is protect that plan.
And that's where they'll skimp on things like the
Exactly.
underinsured and uninsured motorist portions of the coverage, because they have to have maybe a certain level on the auto liability and stuff like that. But there's other mm-hmm. things around the edges that they can skimp on to get you a better quote,
right,
to save money on your premium.
And therein lies the problem, because they want to get your business, and they would rather cover you not quite as well as what you really need, but what you said, than not cover you at all and you go someplace else where you get screwed over, right? Mm-hmm. So the way that you need to go about shopping for insurance is you need to go to that independent agent and you need to tell them very specifically what I want, right? Here's what I want. Now go shop that. So here's the way that I would recommend that we do it. When it comes to your auto policies and your homeowners policies and the umbrella policies, the umbrella policy is actually, in my opinion, one of the most important, but the umbrella policy keys off of auto, not homeowners. So here's the way that I would recommend that you go about doing it, and I'm pretty sure you're in agreement with me, is you need to take your total net worth and round it up to the next $1 million, right? That's the way that umbrella policies are typically sold, is in $1 million increments. So for the vast majority of people, it's a $1 million policy, right? Umbrella policy. Okay, now, you're going to automatically get what's required on auto coverage by the umbrella. So, for example, with the one that I personally have, I've got $1 million umbrella policy on there, and the underlying requires $250, $500, $100 mm-hmm. coverage. Okay, now here's where it gets a little bit sticky, right? I also require that my umbrella has uninsured, underinsured coverage. Interestingly enough, most companies do not offer that on their umbrellas. And the typical agent is not going to include that because it causes the price to go up. Umbrella policies are cheap. They really are, until you start adding on little things like I just said. So when you add those things on, you create potential problems. And it causes the price to go up, and they might lose the client, right? Tell them that's what you want. I need this number of millions of dollars of umbrella, and I want uninsured, underinsured motorist coverage on the umbrella, and then you'll get the supporting coverage for auto. Then on homeowners, this is where it gets interesting. The homeowners does not affect the umbrella, but the umbrella does cover the homeowners. But where people get in trouble here is they say, okay, I have a $400,000 house, for example. So I need to get a homeowner's policy that covers a $400,000 house. That's not actually correct. And here's why I say that. You can go buy a house today. Let's just say, Eric, that you're going to sell your house to me. Right? And the selling price is $400,000. So I pay you, I go get the mortgage, I pay you the $400,000. I get your house. And my new house burns to the ground. I can't replace that house. I can't build it back to exactly what it was for $400,000. Realistically, with the cost of a lot of materials that are out there, mm-hmm. it might cost me $600,000 to actually build that house and to replace the appliances and everything exactly to the level that it was. So if I've only got a $400,000 policy and I have a true catastrophe, like a fire that burns it all the way down, I can't rebuild my house to what it was, even though I thought I had, here's that phrase again, full coverage.
Full coverage. Dangerous words.
Yes. The phrase that you need here is total, keyword there, total replacement cost. So it doesn't matter that this house that I bought from you is worth $400,000 because that's what I paid for it. So that's what it's worth. It's going to cost me $600,000 to rebuild it. Well, the insurance company is going to pay whatever it costs to rebuild it to what it was. Yeah. So it's very, very important on the homeowner's side. Total replacement cost is key. So when you're shopping your insurance with your independent agent, I want total replacement cost on my homeowners. I want an umbrella policy, whatever number of millions you need, and they will with uninsured, underinsured motorist coverage. That's very hard to say multiple times on the umbrella policy, and then the underlying auto policy will support it. Now, one little caveat, right, before we move on to the next thing is when you get to a certain point with the umbrella policies, the coverage on the auto gets so high that what's required that you really don't need that $1 million worth of coverage on your policy. So you don't necessarily need to get the $2 million policy. The one was enough because of what the auto covered on top of it. So kind of work through that. Talk to your financial planner. They will walk you through exactly how much coverage you should have.
Yeah. And so another thing to look at, yes, I mean, obviously you want to look for total replacement or guaranteed replacement of the structure. So when you're getting a homeowner's quote, you're typically going to see what's called dwelling coverage.
Yes, exactly.
So dwelling coverage is estimated value of your home, whatever you think the value of your home is or estimated what the insurance company will basically assess the value of your home to be if it were to be a total loss, right? So obviously that might not necessarily be enough to cover the replacements of that home. So what a lot of insurance companies will do, they will write an additional replacement type policy. And so this is where you're going to see that guaranteed replacement or total replacement. So if you have a $400,000 house with total replacement and it costs $700,000 to replace, you will get total coverage up to the $700,000 or whatever the total amount was to replace it. Other policies will give you like an additional 50% replacement type, meaning so if the structure is or the dwelling is insured up to $400,000, you will get an additional $200,000 on top of that for up to 50%,
of the
right?
Right.
So basically, you'll get $600,000 to rebuild your house in this scenario.
But if it costs me $700,000, that other $100,000 comes from your pocket, tab, right?
Your pocket. So just something to be aware of. Yeah. And a lot of that is also dependent upon what the dwelling coverage, what that number is. So if you think that dwelling coverage number is maybe too low relative to what you think the value of your house is, so there's some adjustments that can be made on the dwelling coverage. But this is going back to the whole idea. There's all kinds of different levers that these insurance agents can pull with these different insurance companies, right? And so if they're trying to get you a quote that's going to fit into your cash flow needs, or your only concern is what you pay out of pocket for your premium every month, well, then they can lower things like the replacement cost. So instead of 75% replacement, they're going to do 50 or 25% replacement or zero replacement, right? Right. Because you're trying to get a lower premium, and that lower premium is going to obviously afford you less coverage, right? Yep. So then there's some things that they can do to play around with the dwelling coverages and stuff like that. So there's all kinds of different things that they can mess with. But usually that dwelling coverage directly impacts things like the replacement coverage, but it's not just the replacement coverage if the home were to, let's say, go away in a fire, right? You also have things like personal property, right? Personal property, other structures. So if you have any other structures on the property,
like for example, I have a pole barn.
Yeah.
Right. So that would be other structures, right?
Pole barn, shed, pool, whatever, whatever other structures you might have, detached garage, right, et cetera, right? So what's the cost of rebuilding that? Because that's not necessarily going to be included in the dwelling coverage.
Very good. Thank you.
Right? So you have to understand, okay, well, if the other structures that are included, what's that going to, usually that's a percentage of the dwelling coverage. Right. So in most cases, it's somewhere around 25%. Some might go up to 50%, something like that. Personal property, usually that's going to be 50 or 75% of the dwelling coverage. Right. So the dwelling coverage, all these other different levers kind of key off of the dwelling coverage. So whatever the cost of replacement on your home is, or whatever the value of your home is, all of these other levers are going to key off of that number. Right. And so it's usually going to be some percentage of that number for the total replacement, for the personal property, for the other structures. Anything else is going to key off of that number.
So right now, people who are listening or watching are going, holy cow, I had no idea there was this much going on with my insurance. And that's the point. If you are shopping on price alone, you're not necessarily getting the correct coverage, right? So I want to transition a little bit.
Actually, let me add one more to that real quick too. Loss of use is another big one.
Oh, yes, good point.
So
explain that.
So loss of use. If your house goes up in flames and you have to replace your house, well, you can't really live there while they're rebuilding your house.
True.
So you need to go live somewhere else, and that's probably going to cost you some money, right? So the loss of use is how much the insurance company will cover for you to go live somewhere else, to reimburse you for your fees to go rent another house somewhere else.
Right.
So that's where, once again, you can get into total cost.
Uh-huh.
And they'll pay 100% of the cost to cover your relocation fees, if you will. Or most commonly, it's also, once again, going to be a percentage of the dwelling coverage,
Right.
Usually somewhere around 25% or so.
So the transition that I want to make here, that was a great point on loss of use. I wasn't even thinking about that. Something else that you mentioned that you were dealing with this client that you got all these quotes from this week was the deductible.
Yes.
And I think people get a little freaked out on deductibles. So remember, the whole point of a deductible is that you have to pay this amount before the insurance kicks in.
Yes.
Right? Now, in practice, there's simply whatever the cost is to fix or replace. They're just going to discount how much the insurance is going to pay by your deductible. Okay. But here's the interesting point. We know that the higher the deductible, the lower the premium.
Mm-hmm.
And the reason for that is, remember what insurance is. True insurance is you're just taking risk and you're paying somebody else to take that risk for you,
Mm-hmm.
right? That's what an insurance company is. But the deductible is the part of the risk that you're still going to carry, right? So if I'm carrying a $100 deductible, that is not a lot of risk, right? On the other hand, if I'm carrying a $5,000 deductible, that's a much higher risk that I'm personally having to bear. Therefore, the insurance company is not bearing as much, and therefore I'm going to get a cheaper rate. So that's how that works. What I found interesting about the one that you were talking about was not that there was a deductible. So I'll let you walk through it. They opted to take a fairly high deductible, but the savings were substantial. But what I found interesting was that they had different deductibles inside of their homeowner's policy. So why don't you walk us through that?
So essentially what happened with this client, they got 3 different quotes from their insurance agent, right? And essentially all of the different quotes were good. The coverage was all favorable. The coverage was pretty much in line with one another. So there wasn't really much of a difference in the level of coverage that the insurance would take care of if in the event something were to happen.
Right.
The dramatic difference between the 3 quotes was going to be obviously in the premium and the deductible. Okay. And just to give you an idea of how big of a difference the deductible can make in regards to what your insurance premium is going to be. So in the first quote, there was a $1,000 deductible, and this is strictly on homeowners because auto has a separate deductible, right? So on the homeowners insurance, there was a $1,000 deductible, meaning so the house goes up in flames, you pay $1,000. You pay $1,000 to the insurance. Yeah, exactly. Right. The second quote, which was obviously a little bit cheaper on the premium, had a $2,500 deductible.
All right.
Okay. The third option had a $20,000 deductible.
Yeah. Wow.
So at first glance, you're going to say,
you're grabbing a hold of your chest.
Oh, that's a lot of money. Right. That's a lot of money out of pocket, right? Yeah. And it sounds on its surface to be very much
that sounds horrible.
Difficult, surface, right? Difficult to grasp, right? Yeah. That's a tough. That could potentially be a tough pill to swallow. That's a pretty high deductible. But when you start doing the math and you start looking at what that does to the premium. In this case, that $20,000 deductible, and once again, we're also talking about because most of these are bundled together between home and auto. So the total quote has the home and auto bundled, but with a $20,000 deductible on the homeowner's insurance policy, the actual premium from the first quote with the $1,000 deductible was $7,000 a year less.
Wow!
So you're saving $7,000 a year in premium for obviously a $19,000 difference in the deductible. So,
let's do some math.
Simple math tells you if you
3 years in,
exactly.
If you haven't made a claim, you've made your money back.
Exactly. And so we kind of walked through this with the client, and the clients, at first glance was a little bit alarmed at the high deductible plan. But as I was going through their plan, I looked at, okay, well, what do you have in reserves? What do you have in your emergency fund? What, how much do you have in your investments? How does this fit into the overall structure of your financial plan? Then I asked, how many claims have you ever made on your homeowner's insurance?
Right.
Like, how often have you ever used your homeowner's insurance?
Hopefully not very often, right?
Hopefully not very often, right? And, there's an old Chris Rock bit about what insurance actually is, and it shouldn't be called insurance. It should be called in case stuff happens. And he doesn't use the word stuff.
He doesn't say the word stuff, right?
But, it's in case stuff happens, right?
I suddenly have a need to go see that because I've never heard that one before.
Oh, yeah. There's an old Chris. It's not safe for this podcast at all. But anyway, so we started kind of going through the options like, well, how many times have you ever actually used your insurance? Well, we've replaced a couple roofs. Over how many different houses, how many different years? Oh, probably 20 years. We've done it twice on 2 different houses. Wow. Okay, so, I mean, was there like an event that you needed? Was like the lightning strike your house? Or was, oh, no, just, it was basically old age and we had somebody come out and basically say we had enough hail damage to qualify for a new roof. Right. And so we were able to get it covered by insurance. Okay, so it wasn't an emergency that necessitated the need for, making the claims, right?
But you're going to pay $7,000 a year more for how many years
in premium
before you actually use that?
And so from there, it's like, okay, so we established that baseline, if you will, and then we asked, okay, well, how old is the house that you're buying?
Right.
Well, it's like 6 years old. Okay, so it's not a very old house. Is the roof in good condition? They have your inspection. The roof is in good condition. All the other stuff is in pretty good condition. So what are the chances of you within the next 3 years having to file a major claim on your homeowner's insurance?
Very low.
Pretty low.
Very, yeah.
Very, very, very low, right? And obviously if something were to happen, force majeure, right? Some act of God, well, you can't control that. But if that were to happen, I asked the client, I said, okay, well, let's look at your plan. Let's look at your assets. You've got enough in your assets to cover that deductible if the worst case scenario happens over the next 3 years. And so, and keep in mind, you can also, if you ever get into a position where you want to, maybe rerun the numbers on your insurance, you can do that at any time. You should any qualified insurance agent is going to tell you at least every 2 years, at a minimum every 2 years.
You need to rerun the policy, right?
You should be rerunning your policy and looking at your numbers to see if your coverage is still right and see if there's something better out there. But yeah, in this case, the client went with the $20,000 deductible because everything else was essentially the same in regards to what the insurance coverage was going to cover in the event of a loss. Right. So it's not like they were taking on less insurance coverage, but they were getting a significantly lower premium for the same amount of coverage, obviously with a higher deductible, right? There's always a trade-off. There's always a pro, there's always a con. In this case, we weighed both, and the client made the decision to go with the higher deductible plan. No different than your medical insurance, right? So if you get a high deductible medical insurance plan, which is quite frankly pretty much all anybody uses at this point for the most part, we probably need to do an episode on medical insurance, and maybe even going without it, because that's something that I've been toying with as well. But anyway, it's no different than a high deductible medical plan. You're going to have a much higher deductible, but you're going to have a much lower premium.
Okay, so interesting, and I'm going to make this part very brief. The high deductible health plan, you're going to have an HSA account where you can save money to pay that big deductible.
Boom.
So to your point, this client they're going to have what'd you say, $20,000 deductible?
It's a $20,000 deductible, but they're going to save, it's less, it's just under $7,000 a year.
But let's call it $7,000 a year.
In premium, yeah.
Okay. But they would have had a $1,000 deductible, so it's really $19,000. So in the math says, if you can go 3 years without having a claim.
Not even 3,
statistically,
2 and a half.
Okay, 2.5, 3 years. Statistically, you're going to go that long without a claim. What could you do with that $7,000? And my immediate thought is, maybe we set up a fund to pay your $20,000 deductible, and now the money is set aside in a separate account, or it's sleeved in a brokerage account, or whatever you want to do with it. Now it's truly a $7,000 savings a year for as long as you have that policy before it needs to be updated. So I think that's a fabulous example of you get some sticker shock at first when you see that high deductible and you go, holy cow, I could not survive that. Well, first of all, in many people's cases, you can, right? Mm-hmm. And second of all, if you are diligent with the way you set aside some money for a few years in this case, now you're so much better off than where you were. And that's kind of the point of understanding the type of insurance that you need and the type of coverage that you need, and then going out and shopping price. And quite frankly, also shopping insurance agents.
Yep.
Because of the way that I will throw out a shout out. My younger son wrecked a car of ours a couple of years ago. There's a theme here. I hope my kids are listening to this. Wrecked a car of ours a couple of years ago. And, it didn't seem like a lot of damage, but because of what the damage was and the age of the car, they said, no, we're going to total the car. And I'm like, oh my gosh, this car's not worth $4,000 or $5,000 at this point. But because of the type of coverage that my agent, same agent that you use, had put on our vehicles, I ended up getting a considerably higher amount on replacement of vehicle than what it was actually worth, because they had done the right thing. I paid a little bit extra for the policy, but it pays off. So you're shopping not only, you're not shopping just price in order to get this is the amount of coverage I need. You should also be shopping agents to make sure that it's somebody who aligns with the way that you think things should be done.
Yep. So
I am going to do exactly what you just did, and that tells me an awful lot about your opinion here.
Yeah. So let's talk bourbon. That was a lot of numbers.
That's a little overwhelming.
A lot of data.
We could do another full episode on the types of insurance that we didn't talk about. We've talked exclusively about property and casualty right now, and I think that's enough of that. Yeah. What do you think, man?
It's good. I like it a lot. You said it was kind of that $50 price point, although you might not have to.
You may not be able to find it at that price point, but
I will say this. So I was, I had some sips obviously prior to putting a drop of water in.
Mm-hmm.
It went down a little. There's a smoky flavor which I like, but it went down a little rougher than most wheats will.
Okay.
I put a drop of water in there. That smoothed it out a lot. And it was like one. I mean, it was like one drop of water that I put in,
and
that's
it's
the point. And it smoothed it out.
Watching this, that is the point. You don't pour water into your bourbon when you're trying to get little nuances. You do it. You measure it in drops. Mm-hmm. That's the reason that we use a very specific dropper in order to be able to portion that water out. You know what? I don't get the smokiness. What I do get,
I got it before the water. Now the smokiness is gone, but it's a lot more. There's a lot more honey.
There's a lot of honey,
more vanilla.
And I'll tell you, I get a mouthful of butterscotch after I put a couple of drops in this. And it's so good.
That's similar to honey. Yeah.
Yes. Oh my gosh, tell me that is not a fantastic bourbon for a 94 proof. Usually you don't get this kind of flavor out of something that's that low of a proof.
But no, it's I like it. It's a good one for something I've never heard of, never seen.
It does specifically say that you will be complemented by hints of fruit and vanilla. Okay, vanilla is a common flavor.
I don't know about the fruit
in bourbon, and I can tell you there's a lot of vanilla in this, and it's great. The fruit, I don't get that.
I don't get that.
And I do get fruit in other bourbons. It's not one of those I don't ever taste fruit. This could be, if the price was right and it was readily available, absolutely be that quote-unquote daily drinker. I think a better phrase would be your go-to.
Yeah.
If I get home and for whatever reason I'm going to have a little pour of bourbon this evening, I wouldn't hesitate to have one of those, right?
I think what's cool about this one, once again, I mean, I'm not saying I'm the biggest bourbon drinker at all, but it's not like I haven't had a lot of different kinds, right? We have a bourbon podcast. I've never heard of this. I've never seen it. I've never heard of it. Didn't know it existed. If this was the kind of bottle that you had at your house, it's one of those things where I would imagine there's probably a lot of people like me that didn't know this kosher version of Buffalo Trace existed.
And you know what? To me, that's one of the things that's fun about bourbon.
It's cool. Yeah.
I've got quite a few things at my house that would probably make even somebody like you who does know what they're talking about. there would probably be quite a few things where you'd go, holy crap, I've never even heard of that, like the koshers. And at the same time, I go to our Bourbon Snobs group that we've talked about and you've visited. Half the stuff on the table every time we meet, I've never heard of that.
Yeah.
Right? And I'm fairly well versed. It's just overwhelming how much stuff is out there that I didn't know I didn't know that company existed, much less that particular version of it. And that's what makes bourbon great is there's so many ways to experiment. There's so many different flavors that are out there. As your palate increases, right, as you get more acclimated to the different flavors that are in bourbon, you'll find so many things that this one has it, that one doesn't, and this one has something totally different. And that's what makes it just what a great spirit that this is that we have here in this country.
Yep. No, that was a good pick. So
I love this stuff. This makes me want to go out and buy more. I hadn't opened this bottle in over a year, and wow.
Clearly I saw the dust on it.
There's a little dust on it,
yeah.
right?
But yeah, good deal. So, any parting thoughts?
Parting thoughts. Insurance is not a fun topic.
Yeah.
Who wants to talk about this stuff? But it is such an essential thing because odds are you're going to have to deal with it. You're going to have a homeowner's claim. You're going to have an auto claim, right? I did not know yesterday morning when I got to the office that I was going to have an auto claim today. I will throw a little caveat into me. We're making fun of you or I make fun of you for having that 10-year-old Toyota Camry, and you're like, dude, I got a Camry. I'm happy. I did pick up the rental car.
Yeah.
And when we got there, I took my wife and my son and I, and because my son is under 25, the rental company said, yeah, you can put him on, but it's an extra fee. And we said, well, how much? And they said, $25 per day. Mm-hmm. It could be weeks before the car is finished. And the numbers hit really quick in my head. Okay, all right, my son is going to get to drive my car that I love, that I just got out of the shop yesterday, and I'm going to have to drive the rental. What are we getting? I got a Toyota Camry.
There you go.
Hybrid. And remember, I'm a car guy. I like the grunt. I like the sound of an engine, and I got a hybrid. It's going to be a rough couple 3 weeks until that car is repaired.
Hey,
so
you know what? You got to work today. You got to work today, didn't you?
I did get to work today.
Yeah.
And quite honestly, it's a newer one than yours. It's got all those bells and whistles that we talked about. Mm-hmm. That if this car were damaged in a small incident, the cost of repairing it would be pretty high because there must be sensors and bells and whistles and motors and actuators everywhere in this car. So
my wife drives a 21. I drive a 17. Mm-hmm. The difference between 2017 and 2021 in technology in a car is astronomical. So I haven't driven a 25, 26, anything. But I can imagine it's the difference between 21 and 26 has got to be
It's got to be radical.
Yeah.
I'm with you. My car is a 2017 and my wife's is a 2020.
Yeah.
And they're the same manufacturer. And the technology is night and day. And that's 3 years difference. And now we're 6 years past what my wife's car is. So, big takeaways. Insurance is not a fun conversation. Be it the property and casualty that we've talked about today, be it the life insurance, the disability insurance, the supplemental stuff like the cancer policies and the Medicare supplement policies. This is just a horrible conversation to have, but I promise you, you'll be glad that you've got the right stuff when it comes time to make a claim.
Nobody needs it until they do.
Until they need it.
And
that's
that's what insurance is for. You need it in case stuff happens.
It's kind of like talking about your estate plan. Yep. Who wants to talk about this? This is a horrible subject until it happens. And then you're so glad that you did the diligence and that you went through and you did the work and you got the right policy or you set up the right estate plan or whatever. Because now things are so much easier than what they would have been had you not taken care of that.
For sure. It's a good place to wrap up.
Yep.
Thanks for listening. Thanks for watching. If anything that we said today sparks any interest in you or anyone that you might know, please feel free to share our content. We would greatly appreciate it. Please feel free to give us a call. Numbers found at our website in the show notes below, fwppartners.com. Thanks for listening. Thanks for watching. Until next time.